dividend stocks in focus. They recommend staying interest for the long term and adding in weakness. In view of numerous uncertainties that are currently ramping on the market, quite a few investors have sought to flee. The current environment offers lucrative entry opportunities, especially for high-quality dividend stocks. The current market environment continues to be difficult. In particular, high inflation, ongoing supply bottlenecks, skyrocketing energy prices, and rising key interest rates are making investors frown. It is no wonder that numerous market participants have already pulled the ripcord and left the stock market for the time being. For example, the market-wide US index S&P 500 has now technically entered the bear market. Still, according to experts at the prudent spectacle, investors shouldn't burn their heads in the sand. The Prudent Spectacle is an investor newsletter published by wealth manager Covitz that provides subscribed investors with investment tips. Editors John Buckingham from Philip Van Doren quotes in the MarketWatch article saying, "Whether it's stocks or socks, you want to buy quality products when they're cheap." Buckingham enjoyed the Omo and Warren Buffett's oracle. Exploit periods of weakness. If you are looking for cheap entry opportunities, you will certainly find them in the bear market. Because, as Van Doom writes on MarketWatch, it is particularly worthwhile for long-term investors to access the market during phases of weakness, as this can increase long-term returns. Nevertheless, a well-founded investment strategy is important in order to select the right stocks that actually increase in value over the long term. The Prudent Spectacle focus on high-quality dividend stocks, according to MarketWatch. The investment newsletter's portfolio set an average annual return of 14.5% over the past 30 years, compared to a 9.9% for the S&P 500. The reference date for the calculation was June the 30th, 2022. Quality stocks in demand. In total, the Prudent Spectacle's portfolio included 80 stocks selected from around 3,000 US stocks. When selecting stocks, Buckingham's team focused on quality, but also especially looking for stocks that are very liquid and potentially undervalued compared to the market. However, another important aspect of the investment strategy of the investment newsletter is to remain in the market even when it's weakening, because the attempt to predict weak phases ultimately leads to poor performance of the depot in the long term. Dividend yield of more than 3%. MarketWatch also lists 3 specific criteria that Buckingham would have revealed in an email. Buckingham looks at the dividend yield when picking stocks. This should be more than 3%. The editor writes, yes, interest rates have raised this year, but for those whose shares are 3 to 5 year or long investments, rising dividend stocks will remain attractive compared to bond alternatives. PE estimates in focus. Another future lies in PE estimates announced by analysts for the next 12 months. This could be below the current level of 14.0 for the Russell 3000 Value Index PE estimates for the selected stocks. Not only are the stocks cheaper than the broader stock market, they also have a higher dividend, as the Russell 3000 Value Index has a dividend yield of just 2.3%. Of course, since the beginning of the year. Finally, investors should also focus on year-to-date performance. If it is below 22%, it will present a cheap entry opportunity. We believe that each of these names has a significant capital appreciation potential in addition to the income component, with a significant amount of bad news already priced in. In short, the upside potential of the current low levels is significant in our view, and offsets the business risk of future short-term economic weakness. MarketWatch quote Buckingham as saying, the following 15 stocks meet each of the 3 criteria being at the inspector of JP Morgan, Bank of New York Mellon, Intel, Foot Locker, Broadcom, and Cisco Systems being one of the better known. The remaining titles are Whirlpool Corp, CK Technology, New York Community Bank Corp, MDC Holdings, Manpower Group, Kohl's Key Corp, Greenbrier Coast, and Fifth Third Bank Group. What do you think? Are those titles for you? Let me know.